Welcome back to Bitcoin Dorks. In today's video, we'll be discussing a recent report from the Reserve Bank of India, RBI, that highlights the risks associated with stablecoins for developing economies. The RBI is calling for global regulation to address these concerns. So, let's dive in and explore the details. The Reserve Bank of India, the country's central banking institution, has published a report emphasizing the potential risks posed by stablecoins in developing economies. The report highlights the need for global regulations to mitigate these risks and ensure financial stability. But first, what are stablecoins? Stablecoins are a type of cryptocurrency that aims to maintain a stable value by pegging their worth to an underlying asset or a basket of assets, such as fiat currencies, commodities, or other cryptocurrencies. They are designed to offer stability and reduce the volatility commonly associated with cryptocurrencies like Bitcoin or Ethereum. According to the RBI report, stablecoins can introduce several risks to developing economies. One of the primary concerns is that stablecoins could disrupt the country's monetary policy and control over the money supply. As stablecoins are often pegged to fiat currencies, they could potentially challenge the authority and effectiveness of central banks in managing their economies. The report also highlights the risk of money laundering and terrorist financing associated with stablecoins. Due to their global nature and potential anonymity, stablecoins could be exploited for illicit activities, making it challenging for regulatory authorities to trace and prevent such activities effectively. Another significant concern mentioned in the report is the potential impact on cross-border remittances. Stablecoins could offer an alternative and potentially cheaper way for individuals to send money across borders. While this may seem beneficial, it could pose challenges to traditional banking systems and remittance providers, impacting their revenue and posing risks to financial stability. The RBI report argues that the regulation of stablecoins should be a collaborative effort on a global scale. The absence of comprehensive regulations could lead to fragmented approaches and regulatory arbitrage, where companies exploit regulatory gaps between jurisdictions to gain an unfair advantage. The RBI report emphasizes the need for stablecoins to be subjected to the same level of regulatory oversight as traditional financial instruments. This approach is crucial to ensure consumer protection, prevent market manipulation, and maintain financial stability. By subjecting stablecoins to robust regulations, authorities can implement safeguards that are in place for traditional financial instruments. These regulations would include measures such as Know Your Customer, KYC, requirements, anti-money laundering, AML, procedures, and adherence to data privacy standards. These steps would help prevent fraudulent activities, enhance transparency, and protect the interests of investors and users. Regulatory oversight can address concerns related to market manipulation. By imposing rules and surveillance mechanisms, authorities can detect and deter any attempts to manipulate the value of stablecoins or engage in insider trading. This level playing field ensures fair and transparent markets, fostering trust among participants and maintaining the integrity of the financial system. Maintaining financial stability is another critical aspect addressed by the report. Stablecoins, with their potential global reach and widespread adoption, can have a significant impact on the stability of financial systems. Therefore, applying the same regulatory standards to stablecoins as those governing traditional financial instruments become imperative. It allows for a comprehensive risk assessment, monitoring of systemic risks, and timely intervention in case of potential threats to the stability of the economy. Regulatory oversight plays a vital role in ensuring the compliance of stablecoins with the monetary policies set by central banks. Central banks have primary responsibility for managing the money supply, controlling inflation, and promoting overall economic stability within their respective jurisdictions. The regulations governing stablecoins aim to prevent these digital currencies from undermining the monetary policy objectives or diluting the authority of central banks in implementing necessary measures to steer the economy. One of the key concerns is that stablecoins, with their potential widespread adoption and cross-border nature, could create alternative monetary systems that operate outside the control of central banks. This could potentially lead to a fragmentation of the monetary landscape, making it difficult for central banks to manage the money supply effectively and implement appropriate monetary policy tools. Regulatory oversight ensures that stablecoins operate within the boundaries set by central banks and align with their monetary policy objectives. By subjecting stablecoins to the same regulations as traditional financial instruments, authorities can enforce measures that require stablecoin issuers to comply with guidelines, reporting standards, and requirements for maintaining reserves in line with monetary policy goals. Regulatory oversight enables central banks to monitor the potential systemic risks that stablecoins may pose to the overall financial system. Central banks rely on a comprehensive understanding of the money supply and financial flows to make informed decisions and implement effective monetary policies. By regulating stablecoins, central banks can assess their impact on the economy, identify any potential vulnerabilities or risks, and take appropriate actions to mitigate them. Regulatory oversight helps prevent stablecoins from becoming a tool for evading capital controls or engaging in illicit activities. Central banks often have specific regulations in place to manage capital flows, ensure financial stability, and combat money laundering and terrorist financing. By subjecting stablecoins to these regulations, authorities can ensure that these digital currencies do not undermine these important measures and contribute to a safe and secure financial ecosystem. Regulatory oversight helps monitor systemic risks, prevent capital flight, and combat illicit activities, contributing to the overall stability and integrity of the financial system. That's all for today's video, Bitcoin Dorks. Thank you for joining me as we discuss the RBI's report on stablecoin risks and the call for global regulations. Don't forget to subscribe to our channel for daily videos covering cryptocurrencies.